right.
All right, let's do it.
Okay, so good afternoon, everyone. Thank you so much for attending our ARIA Greater East Bay Chapter May Mortgage webinar. ARIA represents Asian Real Estate Association of America, and we are the Greater East Bay Chapter covering the Alameda County and Contra Costa County. My name is Justin Wong. I'm the president of ARIA Greater East Bay. And before we get started for this webinar, all of this would not be possible without our sponsors. So a special shout out to our double diamond sponsor, Bank of America, our diamond sponsor, Wells Fargo, and our emerald sponsors, Chase Bank, Citibank, HSBC, and Bank of the West. And this event would not be possible without our events committee. So a special shout out to Margaret Lynn, Dale Corpus, John Pack, and also our marketing department with Kita Suzawa and Sin Trung. Last but not least, I want to also give a special shout out today. Today is Laura Tang's birthday. So Laura, if you're on, happy birthday.
Happy birthday.
Happy birthday, Laura.
Happy birthday.
And I didn't forget about the man of the hour that will be our moderator today. His name is Eric Relos. He's our mortgage chair, and it was his birthday yesterday. So happy birthday to you.
Birthday, Eric.
Okay.
It's a heavy Taurus month. Thank you.
So without further ado, I wanted to introduce the man of the hour, our moderator, mortgage chair, Eric Relos.
Thank you, Justin. Similar, I want to thank the speakers, the committee members, and more importantly, the attendees for today's mortgage webinar. A quick self-intro. Some of you already know me, but for those who don't, as Justin mentioned, I'm the 2020 mortgage chair for the Greater East Bay Chapter. I'm a commercial and residential property mortgage broker with 22 years experience as both an underwriter and loan originator. And I am definitely pleased to be moderating this webinar for the benefit of GEB's members. So at this time, I want to go over the goal of the webinar, and it's to educate our members, in particular, our real estate agents, on what loan programs are still available in the market. And we wanted to arm you with this knowledge so that you can direct your buyers to the most appropriate lender source in order for them to get pre-approved so that you can help them buy their dream home. And in order to do so, we invited a couple of very qualified speakers representing both banks and mortgage banks. And what they're going to do is discuss what loan products and what borrower criteria are in the market that banks and mortgage banks are currently offering. And then I'll round out that discussion by briefly covering non-QM loans. Afterwards, we're going to discuss briefly the issue of mortgage forbearance that's been prevalent in the market because of the impact of the SIP. And our speakers are going to discuss the implications to the borrowers who have opted for mortgage relief and how banks and mortgage banks plan to evaluate or work with borrowers in the future as they seek to either refinance their loans or obtain purchase loans when they're buying new homes. At this point, I want to go ahead and introduce our speakers. First up is Michelle Rayo. Michelle is a private mortgage banker with Wells Fargo based out of Oakland, California. As a private mortgage banker, Michelle serves home buyers with very complex income or asset management requirements. She's worked in the mortgage industry for 18 years and started as a loan processor. So she really knows the mortgage process from the ground up. Michelle is active in real estate organizations and currently serves as the marketing and social chair for ARIA San Francisco Peninsula Chapter. And lastly, Michelle consistently receives 5-star reviews, which makes her an ideal speaker to discuss bank loan offerings during this COVID-19 environment. Our next speaker is also well qualified, and that's Katie Perez. And Katie is a 20-year veteran of the mortgage industry. She's worked for major financial institutions, working with both real estate agents and builders. She joined Guaranteed Rate Affinity in March of 2019 and as a vice president in their mortgage lending group. Now, Katie chose Guaranteed Rate Affinity due to the breadth of their mortgage loan programs and their heavy use of the latest in mortgage technology. So per her professional bio, education has been and is a major part of Katie's customer service offering, which makes her an ideal speaker for this webinar as well. So with the introductions done, I'd like to go ahead and just cover the ground rules for Q&A. We're gonna have Q&A at the end of the webinar. So what I'd like the attendees to do is use the Q&A icon at the bottom of the Zoom screen to send questions. And we're gonna have Alex Lago, he's gonna be compiling the questions, and then we'll be reading your questions at the end for the speakers to answer them. So at this point, we're gonna go ahead and dive into our topic here. Before we do that, I'd like to give sort of a backdrop of where we are today in the mortgage industry. So according to a Housing Wire article from May 7th, which is only just 6 days ago, it's now more difficult for borrowers to get a mortgage, even if they have the means to take one on. Data from the Mortgage Banking Association shows that credit availability fell by 16% from February to April, and it's its lowest level since December of 2014. So this decline shows that the standards for lending have tightened, and it means it's more difficult to get a mortgage. And this decline is really across all segments of the mortgage industry. According to the same article, the decline was largely driven by lenders dropping many of their low credit score and high LTV loan programs, including the reduction of jumbo and non-QM loans. So amidst this doom and gloom backdrop, our speakers are going to share with all of us what loan programs are currently being offered by banks and mortgage banks. So Michelle, Katie, I'm going to ask you to come on. In terms of loan programs available, right? Oh, actually, let me back up. In terms of banks, Michelle is going to cover conventional and agency loans. Agency being loans that are eventually sold to Fannie Mae and Freddie Mac. And Katie Perez will be discussing government loans, and those are FHA and VA loans. So I just wanted to make sure everybody understood that, so that when each speaker speaks, they know what they're covering. So Michelle, Katie, what loan programs are still available in the market that banks and mortgage banks are offering? And Michelle, we'll start with you.
So as far as purchase business is concerned, banks are still offering pretty much what they've always been offered in the past. So you still can put as little as 3% down up to your conventional loan, or conforming loan, which is up to $510,000, or you can put as little as 5% down up to $765,600. When in regards to jumbo, we're still doing jumbo purchase loans with 20% down. With the agency loans or the conforming loans, the credit score is as low as 620, so it hasn't changed. And as far as jumbo, the credit score requirement is at 680.
Great. Well, that's great to hear that banks are still in the market. Katie, what can you share from the point of view of mortgage banks?
From our part, we are very much still involved, not just on the purchase, but also on the refi market. Our FHA and our VA is still going strong. We used, prior to the shelter in place, we were able to do FHA loans up to, as low as a 580 credit score, but nowadays we've had to make some adjustments, and we're still able to do up to or a minimum of a 620 credit score for both programs. They're still very aggressively priced. And also, I wanted to just mention that we are able to do a piggyback second on our high balance conforming loans. So that's something that I know a lot of major financial institutions do. But we do have a source for our piggyback HELOCs that we can put together with a conforming loan. So that's where we are as far as the FHA and the VAs. I mean, it's still business as usual. Nothing much has changed to that. We're still entertaining refinances as well as definitely purchases.
Okay. Thank you, Katie. And with respect to both loans offered by banks and mortgage banks, what does the pricing look like in terms of interest rates or any points that are being charged by lenders, both banks and mortgage banks? Katie, we'll start with you.
Our conforming loans are still very well priced. It could be anywhere from the low to the mid threes. I'm not keen on focusing on the exact rates for today just because there's a lot of factors that come into our pricing that makes it difficult to pinpoint it at any given time. And then when it comes to our jumbo pricing, we do work with several investors with different niches.
Katie, you might want to, yeah.
Is that better?
Much better.
Okay, thank you. Sorry about that. So as I was saying, our conforming, both on the true conforming, which is the 510 400 loan limit, is still in the low threes. That's at 0 points. Now, on some days, it's advisable for us to consider looking at lower interest rates, a significantly lower interest rate for a point, or maybe even less. So I always keep that discussion open if I see that there's an opportunity and the long-term benefit is there for my borrower. As far as the high balance conforming is concerned, it's still playing between the low threes and the mid threes, which is still relatively good. On the jumbos, it's hard for me to focus on a range just because we have a very various investors that offer different niche programs for our jumbo programs. And there's also a lot of things that come into play in pricing our jumbo loans. But I would say overall, it's still very reasonable. And considering what we are still able to do, it definitely makes sense for us to have that conversation with them.
Okay, thank you, Katie. Michelle, what does pricing look like from the banking point of view?
And before I quote rates, I just need to let you know my NMLS ID number is 1198643, so I'll be in compliance. As of today's pricing, assuming that the borrower has a 780 credit score, and what I did is I compiled one for the 5% down as well as for the jumbo rates with 20% down. So with the high balance, 780 credit score for a single family home, owner occupied, you're looking at about 3.25 with an APR of 3.524. As far as jumbo rates, we are at, I'm sorry, I switched it. It's at 3.375 with an APR of 3.43. As far as jumbo rates, it's at 3.375 with an APR of 3.549.
Okay, great, thank you. Next question for both of you. So comparing underwriting guidelines from pre-COVID to now in our COVID environment, what have been the biggest changes in terms of loan to value, how borrower income is qualified, what borrower credit is now acceptable? We'll start with those, and then I'll follow up with similar questions regarding debt to income reserves and overlays. But right now, if you can cover, LTVs, how borrower income is evaluated, and borrower credit.
Do you want to take that?
Oh, go ahead, Michelle. I'm sorry.
Oh, okay. So I'm sorry. The question was, what was the loan to value?
What have been the biggest changes in LTV, borrower credit, and how borrower income is evaluated from pre-COVID to our current COVID environment?
So the only difference really when it comes to purchase business is prior to COVID, we're able to do 10% down up to $1,250,000. But because of the current situation that we are in, we curtail that to 20% down. But as far as agency loans, nothing have really changed.
Okay, Katie, on your end?
Well, we're still able to do, I think where we really stand out in today's environment is our ability to still do a piggyback second together with, is it still low?
Yeah.
Okay, hold on.
It's really, it's hard to hear you.
Bit of an echo.
Oh,
Maybe
no.
do it without the.
Okay. Is that any better?
Say
Can you
something.
hear me?
It sounded better.
Okay, let's give it a try. Let me know. Sorry about that. So I was about to say that where we stand apart from our bank lenders is that we still have the ability to do a piggyback second, even with our conforming high balance loans. So the only thing that probably changed as far as our guidelines are concerned is the credit score requirement, as I mentioned earlier on the FHAs and the VAs. We increased it from a minimum of 580 to a minimum of 620. That's really all that I've seen as far as the credit scoring requirement is concerned. LTV is still the same. We're still able to do a 3% down on some of our programs. FHA is still just 3.5%. So it's business as usual.
Katie,
Okay.
let's try you without the headphones. It might be better.
Yeah, let's give it a go. Let's give it a go without the headphones.
Okay.
So take out the headphones from your computer.
Okay. I changed headphones. Is this better?
Yeah.
Much better.
Okay,
Oh my,
there you
yeah.
go. Sorry.
All right.
Okay, cool.
I had two sets there. I'm so sorry about that. Did you want me to answer that again, or were you able to pick up on what I
Yeah,
said?
let's why don't you repeat what you said if you don't mind.
And thanks for monitoring that, Michelle. I appreciate it.
Awesome.
How far back did you want me to go?
From the beginning.
We'll just go. So we'll just go. The changes in underwriting guidelines with respect to loan to value, how borrower income is evaluated, and borrower credit.
Okay. So as far as loan to value is concerned, nothing has changed, as I've mentioned. And again, what we're able to add to the table is it's still our ability to do a piggyback second with our conventional loans. That still has not changed for us. The only thing that has really changed is increasing our minimum credit score requirement for the FHA and the VA loans. We had to go up from a minimum of 580 to 620. But everything else is still the same, both on the business purchase and on the refinance business.
Okay. Well, that's great to hear. So it's not all doom and gloom. So
No, not at all.
Yes. So same thing with underwriting guidelines. This time, with respect to debt to income ratios, reserve requirements from borrowers, and any overlays, what's been the biggest difference pre-COVID to COVID? And this time we'll start with you, Katie.
The biggest change that I have seen across the board would be on the reserve requirements, I would say. And I think it has a lot to do with making sure that whoever we put in a home or whoever we refinance into a better situation, especially in today's environment with shelter in place where a lot of people's employment is on the line or we're actually affected, it's more important for us to make sure that they have the reserves. From my financial planning perspective, it just makes sense to do that. And so that's where I've seen the biggest change would be on the reserve requirements. Was there anything else that down payment, like I've mentioned, we're still able to do a piggyback second, so that has not been greatly impacted at all.
Okay. Yeah, so is reserves debt to income calculations or ratios?
It's a combination. So when we see, we take into consideration the credit score, the debt to income ratio. We're still with some of the investors that we work with, we are still able to expand the DTI ratios, but it could result to a higher reserve requirement. And also the quality of the reserves. We're looking at liquid reserves more so now. But again, because of the world that we're in, as correspondent lenders, we have a varied source of investors that we look at that could offer still, they have their own niches that we can look into.
Okay. And Michelle, how about on the banking end?
As far as debt to income ratio is concerned, it hasn't really changed. With agency loans, excuse me, we can still go up to 50% loan to value. So even if it's 765,600, debt to income still at 50. Jumbo loans, it's up to 45%, but debt to income ratio is just one aspect of the loan, right? Even if it goes beyond 45%, we'll still entertain that.
Okay.
We don't trend down loans because of debt to income ratio.
So if somebody had strong credit and high reserve, you guys can push on the debt to income ratio?
Yes.
Okay. All right. Now, I don't know if this applies to banks, but are you seeing any overlays that either your bank or banks are adding to what's being required by the agencies? We'll start with you, Michelle.
Not really. I mean, again, business as usual when it comes to purchase business.
Okay. And you, Katie?
Same. It's business as usual. We underwrite based on the AUS.
Got it. All right. So the basic consensus is that, definitely loans are still available. There's jumbo loans available. There's also seconds that are available. So, it's not quite the bad news that sometimes we hear out in the market. There's capital still available for qualified buyers. It looks like some of the lenders have tightened up a little bit on credit. Maybe they've gone down a little bit in LTV, but pricing is still very good. Money is available. Before we go on, I know that Michelle had a special loan program for borrowers that are union members. Michelle, can you cover that real quick?
Yes, thank you so much. So Wells Fargo is one of the only, the only program, or has the only program that's endorsed by AFL-CIO, which is which is the Union Plus mortgage. And this is an incredible program because there are 14 million union members all over the country, 58 national subscribing unions and 30 locals. Members, retirees, spouses, domestic partners, parents, children, stepchildren, and union members are eligible for this program. What's unique benefits of this is Wells Fargo will give gift card of $500 if it's a purchase and $300 if it's a refi. But what attracted me to this program is because of the mortgage assistance. As we all know, there's a lot of people that are losing their jobs, getting sick these days, getting furlough, and these people need help to pay for their mortgage. So there's a mortgage assistance program. This is grant and interest-free loans available to customers facing financial hardships or loss of income, such as layoff, disability, and strike. This program is just one of the 25 benefits available to all union members and their families.
Okay.
So thank you,
Michelle,
for reminding me about that.
All right. And as I mentioned earlier, I was going to briefly discuss non-QM loans. And for those who don't understand what non-QM means, it means non-qualified mortgage. And it's a type of loan that typically doesn't meet the traditional standards of income documentation for a borrower, which for the most part is the requirement of tax returns. So non-QM lenders are more flexible, and they really rely on alternative documents, for example, bank statements, CPA letters, to evaluate complex borrowers. And by complex, I mean self-employed borrowers, real estate investors, foreign nationals who typically don't qualify for a loan from a bank or mortgage bank. So, because of COVID, many non-QM lenders halted their lending programs in March, you know, I got stuck there. Halted their programs in March due to the coronavirus wreaking havoc on the financial market. So, however, according to another Housing Wire article, also dated May 7th, non-QM is starting to make a comeback. The article mentioned 3 lenders that have re-entered the market, but really many of the big names in the non-QM space still haven't come back to the market. So although non-QM is beginning to open up, things still aren't back to normal the way they used to be. I reached out to 3 of the lenders who were mentioned in the article and got some updates on their loan offerings. What I'm going to do is I'm not going to go into the detail of the loan offerings. I'm just going to cover it on a broad basis. But similar to what Michelle and Katie shared for both banks and mortgage banks, the underwriting requirements or guidelines have changed. So typically, the FICO scores have increased. So for many of the lenders, the minimum FICO score is 700, or 680 to 700 is the minimum. Also, their LTVs or the loan to values have gone down. Some of them are at 60. There's one at 80. But again, this is all depending on the strength of the borrower. And one of the biggest changes in non-QM lending has been the increase in the reserve requirements. I know Katie and Michelle mentioned that earlier. In this case, you know, they're looking for cash reserves to cover maybe at the minimum 9 months worth of principal, interest, tax, and insurance payments. So, you know, information is still coming out on non-QM. I'll continue to follow up with the lenders to get a better idea of what their loan offerings are, and more importantly, what their processing times are. But at this point, I've got some follow-up questions for both Michelle and Katie with respect to you know, benefiting our members. And the first question is, Katie, Michelle, what advice would you give to real estate agents that have clients who are planning to buy a house in 2020? Michelle, we'll start with you.
My advice is for the buyers to actually get fully underwritten by an underwriter. Even before COVID, I always, you know, advise my clients to get their loan all ready to go. So it's like once they have that fully underwritten approval, it's like walking around with money in their pocket. They can confidently write an offer with no loan contingencies. Okay. Nowadays, because guidelines change sometimes every day, and it could be like effective immediately. We're no longer doing, you know, this program or that program. I would suggest for loan officers, real estate agents, and borrowers to be to have that communication like once a week, because you never know, things could change. The borrower could lose their job, or you know, they're getting their down payment from stocks, and you know, they lost all that money. So it's very important that you communicate. Okay,
Katie, same question for you.
Yes, and very much agree with Michelle's message there. Now more than ever, it's important for the agent and the buyer to work together, work closely with their lender, because there's a lot of changes. And sometimes it may not necessarily be changes in guidelines per se, but with the requirements. So like for income documentations, and it's really more important these days to keep the lender as an integral part of that team. You know, whenever I'm talking to a prospective client, I always tell them, you're hiring your team. You're choosing which agent will represent you on the negotiating front, and you're choosing a lender that's going to make sure that you have the financing available. So it's a team effort. I cannot emphasize on that enough. It's really a team effort. And when it comes to agents presenting their offers, include the lenders in that conversation. Let us know when you're making an offer, when you've made the offer, because Michelle and I discussed this when we brought it up yesterday, that we also would like to be part and let the listing agent assure the listing agent of the due diligence that we've taken to determine the buyer's qualification. So it puts everyone at ease that way.
Yes.
Okay. Thank you, Katie. So let's pretend I'm a real estate agent. I've got a pre-approved buyer and there's a property we've identified. You know, they want me to write an offer. What advice would you give me as a real estate agent regarding, you know, completing the purchase and sale agreement with respect to maybe appraisal contingency, loan contingency, or any other items on the purchase and sale agreement that you know, a loan has an impact on? Katie, we'll start with you.
I would say be honest in what you're putting on that offer. You know, again, talk to your lender, find out what's a realistic expectation for an appraisal contingency, for a loan contingency, because you know, if you put something there that's too good, the listing agent also has their set of lenders that they work with that they can easily try to cross-reference and verify the validity of that offer. So you want to make your offer as honest as possible, I would say. You have to have that integrity when you're making that offer, because there's always a way for the other party to look into it. Now, everybody knows that in today's environment, it's harder to come by an appraiser that could be able to do the job and take the order. For whatever reason they have, it could be for their own health concerns, for the concerns they have for their family whenever they go out, so they choose not to. So we have an even smaller pool of appraisers that we can use these days. So, and that causes a backlog in their ability to go out there, take a look at the property, submit the report. So that's one thing. As far as the loan contingency is concerned, it's the same thing. I mean, we have a lot of refinances that we're working on. We have a lot, and there's more verification that needs to be done. So it's really important to have that conversation with the lender and find out what is a realistic number to put in those appraisal and loan contingency dates.
Okay. Michelle, from your end?
Similar to what Katie had already mentioned, you know, like these days our firm is not doing appraisals or actual, you know, inspection. We're doing drive-by appraisals. So the appraiser may not necessarily call the listing agent or the buyer's agent to schedule an appointment because it's a drive-by. Just be honest, you know, the 15-day, 21-day close that a lot of agents got used to, I think that's gone. I think we're going back to how real estate really is. You know, it's like 30 days is normal. 30 days close of escrow is normal, and 15 days of appraisal, that's normal, because again, we can only do so much, right? And you know, appraisals can take their time, and right now we have some files, you know, within our team that appraisals taking a long time, and that's pretty much out of our control.
If you were to give a time frame or a time range for appraisals, I mean, is it you know, let's say an appraisal report used to take 7 days to turn. Is it double that time? We'll start with you, Michelle.
I believe so. I think it's, you know, 14, 15 days nowadays.
Okay. And yourself, Katie? The
same. And then there's also situations where we might need a second appraisal to support the value of the first for super jumbo price loans. So yes, I would say the same.
And that's for a purchase? You're requiring a secondary appraisal on a purchase, or is that just refinance?
No. so that's I guess I mentioned the second appraisal. It's for super jumbo loans. So
okay,
yeah.
Got it. Okay,
yeah. As far as refinances are concerned, I actually have a few refinances where the system determined it was eligible for an appraisal waiver, so there wasn't any appraisal benefit. So.
Okay, great. So, thank you both for covering, the lending side or the loan side of the product or our webinar. At this point, we're going to transition over to the topic of forbearance. So as many of you already know, forbearance has been at the forefront of the news and industry discussions as a lot of our homeowners seek mortgage payment relief during this pandemic. So generally, we know that if a homeowner can't make their mortgage payments, one option or the option they have for relief is to call their mortgage servicer and request forbearance. However, we've all heard different and sometimes often conflicting messages on what lenders are offering their borrowers. Some are offering, I guess, 90 days or 3 months. I've heard longer, maybe 60 days. I've heard even sometimes up to 12 months, right? And then more importantly is the discussion of what repayment options are available for borrowers once the forbearance period is over, right? The words I've heard is that borrowers will have to make a lump sum payment. And I think that's certainly going to be tough, if not possible for many borrowers, right? So our speakers are going to help, clear up the muddy waters regarding this issue. So regarding the what forbearance is available in the market, what are banks offering your borrowers? Michelle, we'll start with you.
I can't speak for other lenders. I can only speak for my firm in regards to this. And what I would advise is it's different for every lender or every servicer, right? And so borrowers or homeowners should just call their current lender or current servicer. But as far as my firm is concerned, we are offering 3 months deferment. But if the homeowner truly has a hardship due to COVID, we're able to extend the term, as well as, make some payment arrangements.
Got it. Katie, for mortgage banks?
I would say it's important for the homeowner to contact their lender or the servicer, because every institution might have a different way of implementing their forbearance, and every situation is different as well. And so the repayment plan that might be offered to an individual might be different to the next, even if they're with the same financial institution. So it's really important to get that information directly from the servicer. And if you'll remember, when news of the forbearance came out, just from the get-go, different financial institutions were offering different terms. There were some banks that were offering straight out 3 months. There were some that was doing it on a monthly basis. So it's always advisable for the homeowner to get in touch with their lender directly when it comes to conversations about forbearance.
Okay, thank you. And then in terms of repayment options, we've heard that, hey, you've got to pay a lump sum amount at the end of, let's say, 90 days. We've heard others say that, you can extend your loan terms, right? So if you have, for example, 50 payments remaining, your payments now become 53 because the 3 month that you didn't pay, they'll just tack it on. And, to something as, I guess, drastic as a complete loan modifications. Katie, what have you heard from mortgage banks regarding repayment options?
Again, as I've mentioned earlier, the situation is different. The financial institutions handle it is also very different. So, better?
Yes.
Okay. Thanks, Michelle. So as I was saying, every individual situation is different, and the way lenders handle the repayment would be different. It's on a case-to-case basis. So it's really very important for the homeowner to have that conversation when the time comes. Right now, we're still at that stage where we're still trying to provide relief for homeowners. I have not heard of any specific conversations or any direction as to how the repayment is going to be handled yet. But
Okay.
the point there is call the servicer, call the lender, because that's the only way that they can get an accurate answer specific to their situation.
Got it. All right. Michelle?
Same thing as what Katie had already mentioned. It's very important that they call their servicing company or the lender, because every situation is different. There's, after 3 months, it's payable in full. There's also repayment plan, and then it can go all the way up to loan modification.
Got it.
And by the way, we service all of our loans. So if the homeowner has a Wells Fargo mortgage, please call Wells Fargo for assistance.
Okay. So I know lenders are not supposed to, penalize borrowers with late fees or hit them with default interest rates, if they request forbearance. And more importantly, they're not supposed to report these to the credit bureaus. Based on what you've heard from, senior management, maybe any communication, how are banks and mortgage bank, how are they going to treat borrowers when those borrowers come back either for a refi or if they come to you with a new purchase loan? What kind of guidance or communication have you guys heard from senior management? We'll start with you, Michelle.
Since this is new to everyone, we don't have direct guidance yet from upper management. So we don't know, unfortunately.
Got it. Katie?
It's the same here. We still don't have any guidance or any directions as to what that will look like when we are at that stage, because as I mentioned, we're still at that stage where we need to provide relief to current homeowners. That's the priority, is to make sure that we are able to keep homeowners in their home. And so that's where we are. But if I were to date myself being in the business 12 years ago when we had that drastic situation in the market, a lot of people took advantage of, let's get our loans modified, let's go for a short sale. It was a quick fix. Even if it wasn't necessarily what they needed at that time, it was just providing them like a brief relief. The consequences of those actions were later on realized when they started going out and going for refinances. And then hindsight's 2020, right? It's like, oh, I shouldn't have done that because I could have made the payments. I just want to remind people that because there's still so much uncertainty as to what's going to happen after we get out of the shelter-in-place situation and people are going back to work and we try to get back to the way life that we knew, keep that in mind, because we still don't know what could happen when people try to, if they are still able to, by all means, but just remember what happened 12 years ago. That's all I can say.
And I agree with that. That's a great advice, Katie. I see a lot of social media posts, especially from real estate agents. And I'd like to ask, please stop. I would see posts like, hey, I've studied this, I've looked through so many, but what they don't know is it's different for everybody. And let's not make this like back in 2008 when everyone was going on, doing loan modification or they would stop paying for their mortgage just because that was the in thing to do, or they would short sale just because the value of their home kind of went down. I just hope it's not, let's educate homeowners rather than, giving them false information. So the best advice that you can give your clients if they're having a true hardship is to call their lender or call their servicing company.
I agree.
Great, thank you. So to summarize the discussion on forbearance, the answers are one, it depends on a particular borrower situation. And two, you really should call your mortgage servicer, and based on your particular circumstances, that representative on the other end of the line should be able to guide you to the most appropriate, I guess, option, whether it is forbearance or no forbearance. And then lastly, homeowners should really think hard about whether they want to, I guess, pull the forbearance trigger, so to speak, and the future impact on that homeowner's ability to borrow. I had a client who certainly could afford to pay his home, but as you both had mentioned, because all these people were modifying their loans and getting low rates, he decided to not make his mortgage payments, right? But he kind of waited too late to play this game, and values had gone up, and his lender basically denied his loan mod application, and it ruined it ruined his credit. And at the same time, he was trying to refinance an apartment building, and we had to put him in private money because his credit score was so low.
Mm-hmm.
And he just didn't understand the big picture. So with that, we've concluded both the discussion on mortgage availability and forbearance. At this time, I'd like to open up the webinar to Q&A. If you had any questions, hopefully while the webinar was taking place, you were sending them to us. And I know we have Alex Lago on the side who was those questions. So, Alex, if you want to take the helm and go over some of the questions that our listeners have asked, so that our speakers can answer them.
Alex, go ahead.
Sure. Thanks, Eric. So far we have one question in Q&A. It's from an anonymous attendee. Are lenders doing anything different to verify employment, since more borrowers are losing jobs at this time, and many self-employed borrowers aren't making the same income level as before? So, Katie, Michelle?
Sure. As far as verifying the employment is concerned, it's really important for us to make sure that the borrower is still fully and gainfully employed, because that determines their ability to repay their loan. And also, the other point that I'd like to make is in connection to the forbearance. If we were to, right now, if they have a federally secured mortgage-backed loan, meaning it's with Fannie Mae or Freddie Mac, they're eligible for the forbearance, and whatever comes out of that forbearance conversation down the road, if it's an extended period, if we were to take them out of their current loan at the time that we know they could be potentially losing their employment, we might be doing them a disservice of getting them out of that type of program and into another one. So it's not just a matter of us wanting to make their lives difficult. It's really more in the interest of protecting what they already have and what they are currently eligible to have. As far as the documentation is concerned, because a lot of companies are closed, we don't have the HR department that's readily available for us to contact. We rely on the borrowers to provide us with their most recent pay stubs. So, for example, if I have a transaction that's closing on Monday and I know that they have a paycheck that's coming in on the Friday before, it's important for me to communicate with my borrower, please have that pay stub available for me. So that's how we do the verification of employment these days. Michelle, are you signaling me?
No, actually.
Oh, okay.
Yeah.
Thank you.
But your mic.
Real quick.
Go ahead.
I see a question from Han Tran. It says, for borrowers who do not qualify for a bank loan, would you recommend borrowers consider private lending? And let me address the private lending part. First, I guess you have to understand why they can't qualify for a loan either through a bank or a mortgage bank. But a lot of private lenders, in terms of providing a loan for owner-occupied single family, many private lenders really shy away from that because of the regulatory environment and
Eric, I think we just lost you.
We lost Eric.
Okay, we lost Eric. Oh, Eric, are you back?
will do is they'll offer, typically from what I've seen, they'll offer a bridge loan where, you know, maybe they'll put a loan on a what do you call it, on the existing home so that the buyer can buy the new home. And the LTVs are going to be very low. They're probably going to be in the 60, 65%, especially this environment. So if the borrower has a lot of cash, then maybe private lending, but it's going to be short term, under a year. So I hope that answered that question.
Great, thank you. And we have another question from Phil. What is the minimum down payment buyers need to put down right now? 5% or 10%?
It depends on the loan amount. As I mentioned earlier, up to $765,500, borrowers can put as little as 5% down.
And on our side, again, it depends on the loan amount, the purchase price, because we are still able to do a 10% down up to a purchase price of anywhere from 1.6 to 1.7. So it depends on the loan amount.
Okay. Thank you, Michelle, Katie. We have two more questions. Can lenders consider unemployment benefits to qualify?
I'm sorry, what was the question?
Can lenders consider
benefits?
Yes.
No. Unfortunately, again, it goes back to the conversation of the ability to repay the loan. And if you're unemployed, usually those benefits are for a limited period of time. So it's not something that we can really base our calculations on.
Yeah, there's no continuance of income. So you can't use unemployment as income.
Got it. Thank you. And next question, are there still down payment assistance programs?
There are still some down payment assistance programs. It depends on the county and the city that you live in. I highly suggest you look into them because it's a great program.
Yes, it's still around. Just keep in mind that a lot of these programs vary depending on the city or the county that's offering it and the organization that's offering it. And also, it's a great option to consider if you really have to. But take a look also at the back end of it, because there's some programs that are based on equity share. So that could mean that when the time comes for you to sell the property, you might not realize the kind of gain that you were anticipating from the appreciation.
Okay. So for a borrower looking into down payment assistance, like let's say if I live out in Contra Costa County, I should go to the Contra County website, or maybe specifically in Antioch, should I look at the Antioch website? What's the most appropriate website, county or city?
Eric, you were kind of garbled there towards the end of your statement, but if I heard the point of your message there is, I would recommend that people look at the county and the city, because both counties and cities might have their own program. Most of the time, the information could be found in their housing department page. So that would probably be a good way to start it.
Great, thank you. Next question. If clients are still being paid but are not at work as their employer is closed, which is a casino, can they qualify for a new mortgage based on unseeing that income? It's from Matthew.
So I think, well, if I understand the question correctly, like, so if you're working from home and you're still getting paid, will you be able to qualify for a mortgage? The answer is yes. So I work from home. I'm still getting paid while working from home. So I'd be able to qualify for a mortgage.
What about not working at home?
But still getting paid?
Yes, so the question is from Matthew Townsend. You might want to clarify. It's actually in the chat if you guys are looking at it.
Let me see.
It's probably a one-off. That might be better handled offline.
Yeah. Matthew, if you want to send me a private message, I'll be happy to answer your question.
All right.
Perfect.
I think one last question that I see here says, for business owners that took out PPP loans, does the bank look at that negatively when they're applying for a mortgage? Looks like a question for you, Michelle.
Good question.
Good question. And as I mentioned earlier regarding forbearance, we don't know yet. Since this is fairly new, we don't know.
So if there's not any more questions, I'm making a motion to end the webinar. Justin?
Sure, no problem.
I think we're at time.
Sure, no problem. Once again, Katie Perez, Michelle Rayo, Eric Relos, Alex Lago, thank you so much for your time in making this webinar possible. Once again, a special shout out to our Double Diamond sponsor, Bank of America, Diamond sponsor, Wells Fargo, our Emerald sponsors in Bank of the West, Chase Bank, Citibank, and HSBC. And to all our attendees, thank you so much for coming with your time as well. In the next couple of weeks, we got a couple of more webinars on deck. We have estate planning, we have state of the economy, and a couple of more goodies as we head into May and June of 2020.
Well, thank you for having us. I appreciate the opportunity to speak to your members. If I could have one last word to your members, don't be afraid to go out there, and it's business as usual. No, maybe not as usual, but we're reinventing the way we're doing our business. But it doesn't mean that just because we can't do business the way we used to, that it can't be done. So don't be afraid to go and talk to your clients, be present in their lives, have that conversation with them, and we can still make 2020 something more desirable than what we're currently going through.
True.
Great advice, Katie.
Yeah. Go out there,
Katie.
Help families become homeowners because it's the American dream. Let's make it happen.
True. Thanks
All right,
again. Have a good afternoon, everyone.
Thank
Yeah,
you so much. And once again, hey,
Bye-bye.
Eric Relos, happy birthday as well.
Happy
Okay.
Happy birthday,
Eric.
Eric.
Florida.